Okay, and we had a lot of people RSVP for this, like over 50.
Oh,
So,
wow.
that doesn't mean they'll all come, of
Yeah.
course, but I'm going to let those who are already here in. Hello, Paula. Hi, Vicky. Hi, Burton.
Hey, Shannon.
Hi, hi.
Hi,
Hi,
everybody.
Michael. Hi, Burton. Hi,
Hi, how are
Stephanie.
you?
Hey,
Good.
Shannon.
I'm good. I'm good. Thank you.
Mhm.
Happy Friday, folks.
Yeah.
Be Friday.
All right, let's have some enthusiasm behind that. Happy Friday.
They're
Yes.
retired. They don't care.
Oh, hi, Karen.
Karen's
Hello.
not retired. She
Some of us
cares
She
are
about
not
cares.
Friday.
retired.
So,
Exactly.
Karen, we can
I'm
get an
never retired.
enthusiastic Friday from Karen. There we go.
Hmm.
Oh, hi, John.
Hello, hello. Hi.
Hello.
Oh,
Good to see you. There's Mr. Mark. Hello.
Hello, everybody. Happy Friday.
Happy
Happy
Hey,
Friday.
Mark.
Friday.
All right, we got a lot of people coming in. Love to see it. Hi, Linda.
Hi, Shannon.
How are you?
But I might be in the car switching devices, but I'm heading up to Sonoma. So, but
Oh.
I'm here, I'm listening, and if you see my face jiggling or whatever, just please ignore it, the activity at my end.
No, I will not ignore it. I will adore it. All
Oh, how
right.
sweet of you.
All right. Hi, John.
How are you, Shannon?
I'm good. How are you doing, Sunshine?
Good.
Good. Good to see you. Hi, David. Well, while we're letting people trickle in, just wanted to thank you all for taking some time out of your fabulous Friday to talk markets here with Brio and our very special guest, Brian Nash, a long-term friend of the firm from Goldman Sachs. We're just really excited to have that perspective shared. And, this hour is for you all. So any specific questions you have, feel free to, Brian, is it safe to say interrupt?
yeah, that's fine.
Okay.
You're welcome to save them to the end. You can interrupt, but ultimately we want to get them all answered for you.
Yeah. Right. So he has built in plenty of time for questions, but if you have anything particular in mind, feel free to ask either Brandon, or myself. This
Can we but just at least put this on the queue? How come the stock market is going crazy and breaking records left and right when our economic situation is actually quite poor?
We can
All right.
definitely cover that, Linda. Happy
Okay, I'm
Linda
looking
coming in
forward.
hot. Love it.
to. It's a
I don't
good
want to be a
question. It's a great
conspiracist, but
question.
something's funny here.
Yeah, no, I think you are not wrong in that read of the room, so to speak, Linda. Yes, Paula.
So I'd like to talk about the stock market and private markets and how that all works or doesn't work, and yeah, and what that all means when everything seems to be getting more and more opaque.
Ooh, more opaque. I love it,
Yeah, sorry
Paula.
about that big word.
I,
I know none of you understand it.
I think there's a link between these two questions.
Yes. All right,
Right.
excellent. So, with that, Brian, could you introduce yourself
Yeah.
to the crowd so we can all revel in your expertise?
I will try to do that justice, and I'm going to try to keep up with the wonderful updates you get from John, who I know is out on pat leave. So I hope he's doing well. But to Brandon, to Shannon, and to the team at Brio, thanks for having me join today, and everybody on the line for taking some time out of your Friday. Truly appreciate it. My name's Brian Nash. I've been at Goldman Sachs for a little over 20 years, and I've been in this role working with independent firms like Brio and since 2011. And so my goal today truly is to make you feel like you're a little bit more informed in the market. You
You're
feel a
not
little
on the
bit more
camera.
comfortable with what's going on. But truth be
Camera's
told,
not on.
you have excellent financial planners and an amazing team that you work with. I know you already know that. So your advisors are well informed on all of this. But rather than hearing from Brio.
Oh, sorry. 1 second. 1 second.
There we go. I am muted.
Okay.
Are you okay?
Yeah.
Okay. But yeah, give a third-party view. We spend a lot of time, energy, and resources on research, and I know Brio taps into that internally. But once in a while, it's fun for you to get a peek behind the curtain on how we talk with the investment team at Brio. And so, I think that's the goal today. Hopefully, everybody steps away feeling a little bit better. But as Brandon and Shannon mentioned, like this time is yours. So if you have questions, first and foremost, we want to make sure that we get those answered. And so with that, I thought I'd start maybe a little bit different than you expect. And
Ooh.
let me go ahead and pull up my screen here. And I'll ask, has anyone gone to see Plymouth Rock before?
Wow.
Anyone made the trip out east?
I actually grew up in Massachusetts, so yes.
All right. So Linda, what would be one of the first things you notice when you go see Plymouth Rock? Are you surprised by anything?
How small
You know, in many years, first of all, do I remember even living there? But I just remember there was a rock and there was water and nothing, symbolically, I guess I remember it.
Okay. And
All
did
right.
someone else chime in?
Yeah, Paula, were
Yeah.
you? Oh, Stephanie, yeah.
Yeah, I
Andrew
did.
Danish says much smaller than expected.
So
Yeah,
that's
was
really
super
it. Is
small.
it's much smaller than you'd expect by the stories we've all heard hearing about the history of the United States. And so let's pivot. If you go to the Louvre, and I'm sure many of you on the line have gone, when you go look at the Mona Lisa, one
So
of the first,
small.
yeah, 21 inches by 30 inches, the most famed painting in the world. But what makes it famous is not its size. It's the fact that over 700 years, the Mona Lisa still has this enigmatic look that, depending on how you take a look at this picture, you can see very different things. A smile, a frown, being coy, annoyed, playful. Depending on who you ask, it's in the eye of the beholder of what you see. Now, scientists have actually studied this. And why do people react differently to the picture? And what they found is if you take a narrow focus just on the mouth, you tend to see a frown. But if you zoom out and take in the entire picture, a broader focus of the face as well as the background, 99% of observers will see a smile. We see a very similar relationship when we look at the markets today. If you want to zoom in on any one data point, consumer sentiment, oil prices, the fact that we have two wars going on. These can all be really scary data points right now. But I think when we zoom out as a firm and we look at the economic underpinnings, we look at fundamentals like earnings that we've seen. I think from a standpoint of the market, we understand why the market has remained resilient. And to the original question of why are we at all-time highs, like maybe this feels a little bit too rich for all that's going on. I think that's a fair assumption. But the reality is there are underpinnings why this economy and why this market continues to chug along. And so the goal today, when we get into this, is I want to share Goldman's outlook. Both, hey, what are the concerns out there? What are the sources of volatility that we're tracking? But also, and maybe this isn't what's in the headlines that we're reading, what's some of the good? What's some of the takeaways on why this market's held up and why you should have some confidence to stay invested? So let me go ahead and jump over to our deck.
You
Again,
highlight as an art professor, huh? Love
not
that.
so much. Don't ask me about other paintings. I don't have that depth of knowledge, but on the Mona Lisa, I know a little bit. Now, for this first page, and I'll try to zoom in, we want to look at this chart in the upper right. And what we're looking at there with the dark blue bars is how 2025 ended on a few data points. Oops, apologies. And on 2026 are our forecasts for the end of this year. Now, clearly, the big risk that has happened since the start of the year is the war happening with Iran, the Strait of Hormuz largely getting shut down, and that is the biggest supply source for oil, fertilizers, and other products globally. And this is a big deal as it relates to global economies and as it relates to the stock market. Now, how has that affected things? if we go through some of these numbers, we had US GDP at the start of the year at 2.8%. It's now 2.4. So growth is getting a little bit more challenged. Our economy is not going to grow as fast as it was, but 2.4% growth is not a recession. We would need negative growth 2 quarters in a row by definition to be in a recession. So the operating environment is getting more challenged. And we've raised our recession odds from, call it 15% to 35%, but we're still in a place where our base case is we avoid a recession here in the United States. U3 is a measurement for unemployment. This bears watching. Unemployment last year, and bear with me, I'm just going to close my Outlook so you guys don't see these pop-ups the entire time. Unemployment, we see grinding higher. This is going to bear monitoring. You're seeing new job creations have shrunk quite a bit. Corporations are probably getting a little bit queasier about this environment. It's tough to gauge costs when you don't know inputs like oil. It's also tough to gauge future needs for employment with things like AI in the periphery. And so the labor market is a source of disruption and probably one of the biggest sources of concerns in our economic data that we're tracking right now. But unemployment still remains relatively contained. We haven't seen a breakout of unemployment, but I would say this bears watching. When we get into core PCE, this is a measurement for inflation. And so oil prices skyrocketing. We don't need to talk about the gas pump in the state of California. It's not pretty. Hopefully, many of you have electric vehicles. But what I would say here is we would have told you at the start of the year that core PCE, the primary measurement for inflation by the US Fed, was going to be at 2.1% at the end of the year, right near the Fed's mandate. As you can see, we think inflation grinds a little bit lower from last year, but because of where oil prices sit today, we've increased inflation pretty reasonably. And if the Strait of Hormuz, and this is based on the Strait of Hormuz opening in about a month from now. If the strait is to remain closed longer than that, you're going to see our inflation numbers move higher, our growth numbers move lower, and this operating environment's going to get tougher. And likely the stock market will not hold at these levels if we see the Strait of Hormuz stay closed for significantly longer than a month from now. Now, Fed funds rate. This is the short end of the interest rate curve. This is what the US Fed controls. Lots of talks about the Fed. Is Chairman Powell going to stay on? Is the new Fed Chair Warsh going to get placed in? We ultimately think Warsh does get placed as chair, and we ultimately think Powell will stay on past his chair date as he can stay on as a Fed governor. Time will tell there. But what we would say in our view, and this is not consensus in the market right now, because of the pressure on labor and our outlook that we do think, I don't know if the war ends, but we think the Strait of Hormuz will open sooner than later. We do think the Fed's going to have the ability to cut interest rates later this year, 1, maybe 2 times. This shows it priced in as 2 cuts. I would tell you, that is not a high conviction view. The Fed's going to be cutting based on data. We would need the strait to likely open where inflation's coming down a little bit for that to play out. So I would say this one is a little bit of a gray area on Fed funds. But ultimately right now, what would the benefit be there? Well, if interest rates come down by Fed funds, usually that is a positive for the stock market because it means it's easier to borrow at a lower rate, and that's good for company profits in general. And so if you see Fed funds unable to cut or the Fed's not able to do anything, that could put a little bit of pressure on the market as well. But in our view right now, we think they'll have an avenue later this year to alleviate some of the interest rate pressure. Last point on this page I want to highlight is just the
Brian.
market, and we'll dig into the market in a little bit. But we see the market up about 9%. Importantly, that is all based on earnings. And the question brought in, how is the stock market at all-time highs with all these things going on? And to be honest, I talked about it with my mom yesterday. One of the drivers on why the market is this high, we're about to have our 6th consecutive quarter of double-digit earnings growth in the United States. And so double-digit earnings growth doesn't always happen. 6 consecutive quarters. We haven't seen that in years. And so even though this macroeconomic backdrop, the geopolitical backdrop is there's a lot going on at the company level, companies have actually held through this market. Consumers have continued to spend. And really, that's the driver on why you're seeing this market sit where it does today. Let me check in and see if there's any questions here before I move on.
I have a question. I feel like there's a ton of talk around the Fed and Powell and Warsh.
Yeah.
Does it matter?
It does matter. And I would say where it matters the most is the Fed has been viewed as an independent voice, an independent arbitrator on how to manage inflation and how to manage our interest rate pool and growth in this economy for 100 years. And right now, the concern in the markets, if you talk to market constituents globally, is the White House beginning to pressure or have the ability to pressure how the Fed is reacting? And truth be told, we don't think the White House is going to be able to have all that much all that much input in what goes on. But the White House is putting who they want in for the Fed chair, assuming Warsh gets elected. And at the same time, there's a lawsuit on Powell that the courts are saying it should be thrown out. The White House is still trying to do it. I saw Yellen made a comment last week that this has been the most aggressive political push on the Fed in history. And so that creates uneasiness in the world. If the world starts to feel that the White House is controlling the Fed is no longer independent, and that will not be well received by the markets.
Yeah.
Now, in our view, we think Warsh probably gets in. Will he be good or not? Time will tell, but he definitely has a track record and a history in the markets to have the knowledge base to be in the seat. As it relates to Powell, typically Fed chairs do stay on until their term ends. This is a little bit wonky where the president wants him out, but Powell has said he's going to stay. If you talk to Goldman Research, what they would say is whoever is chair doesn't necessarily have all the power. The power lies with the individuals in the Fed that have the relationships and the partnerships. And so will that be someone who's an outsider who's brand new? Or will it be someone like Chairman Powell who remains on the board, who maybe has the ear of more of the Fed governors than the new person? Because each of those 12 votes counts equally as they're making decisions on the economy. So this bears watching. It absolutely could be a big deal. But given how the Fed's been managed till now, given kind of what I've read internally, I would say we think cooler heads are going to prevail here and the Fed will remain independent.
Hear, hear. All right. Paula has a question. Paula.
Yeah. So, you said things were okay because consumption was up, but what I've been reading is consumption is up among the wealthy, but it is not necessarily up among sort of what I think of as the mass economy, right? So what does that mean in terms of how we think? In other words, it seems to me that the macro numbers that are getting thrown around look pretty good in many cases, but when you dig down, you see that things have shifted. I mean, I'm even seeing it in product lines that companies are now doing, where they're going after the rich rather than what used to be sort of, I'm going to call it the big middle class, I mean, whatever it was. And that seems to be shifting. And what does that mean in terms of what you're talking about in terms of the health of the economy?
So I would say your observation is right. Call it the bottom 50% of the country from an income standpoint is absolutely under pressure. You're seeing subprime loans grow. You're seeing subprime auto loans increase. You're seeing buy now, pay later programs. I think that overall is now like $200 billion industry, which is a little bit scary, where people are essentially signing up with interest to pay things down later. Like everything you mentioned at the lower end is happening. But you're also right about the upper end. And the top 20% of income earners by far spend the majority in this country. And so if the top 20 or 30% are in good shape to continue spending, the reality is the overall economic data is going to continue to look good enough. But that does not mean the whole country is doing well. We clearly have a bifurcated country right now based on income where a lot of people are feeling the pain, and it's been a challenge for a number of years. And the top 20, 30%, frankly, are doing pretty well and continue to spend. So this economy is not humming on all cylinders at all. But when you look at it collectively, that top 20% of spending makes up all of the lack of spending that you're seeing on the bottom half.
Bleak, but accurate, I guess.
Trust me, we need to fix it. There's not an easy fix here, but yeah, the disparity in income across this country continues to grow, and it's something at some point that Washington hopefully will face.
Mhm.
And maybe even talk about, what is income anyway, and I mean, there's all kinds of articles now about how to tax fairly, what does that mean? What does that look like? So another conversation.
Yeah, I mean, that's I'd say a little bit out of my wheelhouse. That's more, government policy and how do we fix things? But I think you're right. Like we need to look at how do we tax, how do we help the lower end of the income rung continue to move up the ladder and have a fair shot at making a life of it.
Brian, if I could ask a question, and maybe you'll get to this, and if so, please just tell me just to, stand by. But from the global perspective, I feel that we're not viewed, the economy is not viewed as strong as it is. Um, and the country seems more unstable than, the data would suggest. So
So
to wit,
yeah,
like,
it's a good
I think it
question. I,
was,
I think the way I don't know if I have a great slide to answer it, but I think the way I would answer that is, the US still has a few arrows in the quiver that make us quite unique as an economy. And so frankly, we believe in the US economic frankly, it's a faster growing economy than the rest of the world. But beyond that, what you see is it's the most innovative country in the world. We've built an economy that allows for innovation of companies, innovation of technology. We know how to scale businesses. We allow for M&A. You contrast that with Europe, where they're trying to do this, but the way their policies are built across countries, you haven't allowed star companies to do M&A and scale to compete with the US and China. And so the US has built a bit of a sandbox here that allows for scale and growth of companies that no other country around the world can rival, and no other country's close. And so that part of it, like the US is the preeminent leader. Now, you get into income disparity, you get into different decisions in this country, no doubt about it. There's you lift up the hood and not everything is great. But I would say like the fact that the US dollar is still the world's backstop and no other currency is close. At times of stress, what's happened the last few months? The US dollar's moved straight up and recovered a lot of the losses last year. 2008, when only our economy was under pressure, there wasn't a global housing problem. What happened? Dollars skyrocketed in value because people go to our bond market and they go to our dollar. So, that lever of having the most liquid debt markets, a currency that's unrivaled by any other for safety, the most innovative country in the world. Those are the marks that China's frankly trying to compete with, and they are at some level, but we're still the front runner. As it relates to income disparity, as it relates to potential, unemployment moving higher and us going into a recession, those are also real points. And so I think it's fair to say there's a lot of work for us to do domestically, but there's also some things domestically that we offer that countries are absolutely wishing they had in place in their own nations.
thank you.
All right, let me keep going and great questions. Please feel free to keep chiming in. Again, I got, 7 or 8 more I'll share with you and we'll make sure everybody feels good about where we end up. I went a little too far here. So, one of the questions we get quite often is, hey, this feels a lot like the 1970s. Why is it not playing out the same way? And if you look here, this Iran war is the most disruptive from an oil supply standpoint of any of the wars we've seen over the last 30 years. However, our consumption of oil relative to our GDP is significantly lower than it was over the prior 2 decades. We've become more energy independent. We are energy independent as a country. We were not in the 70s, not even close. And so this has allowed us to manage through this cycle better than maybe we've seen in past years and past decades. And, again, going back to the question of how are we at all-time highs, the market is always forward-looking. If you think back to the pandemic, the market started to recover during the pandemic, not when we got a vaccine in November. The market snapped back when we got government support and investors said, all right, we're going to have a backstop. We're ready to go in. Now, to try to market time that, virtually impossible. And you're going to leave a lot on the table if you're trying to go in and out of the market every time you see a concern. Because if you leave the market because of the war starting, I can promise you, you're coming back in after it's well above where you exited and everything feels better. So it can be challenging, but stomaching through some of this vol to us is important because when you get into volatile markets, and I'll show this slide later, volatility begets volatility. We will have some of the very worst days clustered with some of the very best. And so that's where it falls back on sound portfolio construction, being well diversified based on your risk profile and your long-term financial planning needs. That's where Brio is an expert. But what I would say here is these are the last 6 or 7 oil shocks we've seen. On average, 6 months after, you see the market about 10% higher. So that's where the market's saying, all right, it seems as though Washington and Iran, if they're at least doing it, at least this morning, it's saying a ceasefire. We'll see what it says by the end of today. But the market's starting to say this is going to be so economically destructive globally. There is no way these parties want this to go on much longer. And so the market's betting that things are going to open up over the next month, and it's not waiting for it to actually happen. Going to, again, like, how does this affect countries? This chart on the left is kind of interesting. Countries like Japan, the EU, or EU is not a country, but a group of countries, India, China, these are energy importers. So they're substantially more affected by these straight shutdowns than, say, the United States, Brazil, or Russia, who are energy independent and net exporters. So the acute pain on what's going on is very different country to country. And the reality is the United States is just in a better position today than we were in the 70s or 80s if we have the straight shutdown like it is. On the right, we show you just different scenarios in how much of an effect could this have on core inflation. And so you see here for like the US as an example, our base case is, we get about 20 basis points of increased inflation. But if it gets real bad, it's about 40 basis points. You look at Europe, real bad looks more like 60 basis points of inflation because they're more of an energy importer. So it's going to vary country by country on how impactful it is. But, and again, this isn't Goldman research, but it was something I read that I think is interesting is part of the reason the White House went to shut down the Strait is China is really impacted if no oil can get out of the Strait of Hormuz. And that's going to create the need for China to potentially tell Iran, hey, we need this to cool down. And so we think that was part of the driver of Washington doing this, is it may create an exit strategy if China can pressure Iran to also say, hey, let's open this back up and get oil moving. So time will tell how that plays out, but that's how we're thinking about the energy market right now. Any questions on that? Otherwise, I'll keep it moving. All right, I'll keep going. Again, jump in as you need. So here's 4 sources of volatility or risk that we're tracking as a firm. The first couple at the upper left, and you can see the chart in the lower left, that is tanker vessels crossing the Strait of Hormuz. Pretty consistent. Usually you see 40 to 70 on average regularly going through. And as you can see, since this war started, it has trickled to virtually zero. This can persist for a little while, but it can't persist for a long time without economic and market destruction. As you look at supply shortages, this is little known fact, but the majority of fertilizer comes out of the Strait of Hormuz as well. So what can this begin to affect? Crop prices. If you don't have fertilizer, you can't plant all the crops. Now supply could begin to dwindle, call it 6 months out, on traditional crops that we use around the world. If the Strait opens up, we can avoid this crisis, but this is a derivative effect of the Strait that in our view bears watching. I've mentioned the unemployment report earlier. Here you can see For us to hit break even on unemployment, which means how many jobs do we need to create for the unemployment rate to remain flat? The answer is we need about 60 to 70,000 jobs a month. Our view right now is the pace of job growth is at 37,000, roughly half of that. Why? We think corporations are a little bit on hold to hire, A, because of the war, B, because of AI, and C, because this economy feels like it's, a little bit on pins and needles at some level. We think it's a little bit more stable than maybe the market, but in the eyes of CEOs, do you want to go hire a bunch of people right now? Or are you going to maybe slow play it to see how some of these themes play out? In our view, that's why you're seeing a little bit of pressure on labor. And then look, we have a very concentrated stock market. This has been very beneficial to all of us invested in the S&P 500 or the Nasdaq over the last 15 years. But the reality is 10 stocks, our top 10 names in the S&P 500 contributed 53% of the returns last year. So the market felt great. We were up 20% plus. But if you boil it down, most of that was on 10 companies delivering. So if we have the big tech trade go sideways, we're going to feel it in the traditional US market much more so than we have over the last 30 plus years. So it's not necessarily a bad thing. If you're big believers in big tech, you're probably very comfortable with this. But, this is why when you're at Brio, you're not just buying the S&P 500. You need to be diversified. This is a market, in our view, you want to be hyper diversified and not tied to one trade or one asset class. All right, let's look at some sources of stability. I don't want it to be all scary. So 38% net margin on those same 10 largest companies I just told you we need to monitor. The reality is their profitability is through the roof. Now you might say, well, all right, they've done really, really well. How much, are they in rougher shape now? Look at this chart in the lower left. Here we were looking at the 10 largest companies in 73, 2000, and 2025. Return on equity today, substantially higher than what you saw in 73, modestly higher than 2000. But take a look at these profit margins. These companies not only are delivering ROE, they are triple the profitability that these tech companies were back at previous market highs. And so in our view, yeah, they're elevated in price, but it's justified. And one of the other dynamics you see with big tech that isn't on this page is the M&A they are doing to buy other companies that they can bolt onto their businesses that help them moat them further from competition is real. They are doing a ton of M&A. Right now, you see a lot of CapEx going into things like AI. And as they invest hundreds of billions of dollars, it's going to create a bigger and bigger moat from other companies to go after them. Now, history will tell you it's very hard to stay at the top of the market. And so as much as we like owning these companies, I would fall back on we don't want too much exposure there. And so that's where the diversification comes in. Because let's face it, with AI, this could massively affect their earnings up. Or if they're on the wrong side of the AI trade and they're not able to monetize it and grow the profits, that could really hemorrhage the returns. And for those tech companies that can't apply AI right, they're probably not going to be in the top 10 much longer. So we're big believers in tech. It's a big part of the index. Structurally, they look very strong right now, but this market still, in our view, tells you want to be more diversified, not less. And this was brought up around, consumer strength. And so here's this chart, and this incorporates high income earners and low. But what you see right now is real household net worth is at all-time highs. The ability for consumers to service their debt, this is households, not companies, is as strong as it's ever been. And so no doubt we've got an unending, I feel like, conversation of concerns we can talk about, but companies are delivering earnings. Consumers on average are in a really good spot. There's a dichotomy there, but on average, you see consumers are in a good spot. And these are some of the underpinnings in the market and the US economy that tell us more to stay the course versus going to the sidelines.
Brian, do you have any more color to add on the 10 billion number for the tax return refunds?
Yeah, essentially we should have a tailwind as it relates to taxes. A number of households across this country are going to get tax refunds, and typically that will spill back into the economy. And so this is just another pillar of strength that's going to allow some alleviation, some additional cash flow for those in the country that are going to get these tax refunds.
So, excuse me for a moment. So you're saying the real household net worth is an all-time high.
Mhm.
Are you basing that on that upper 20%? Because earlier you
No,
said
this
like,
is based on the entire US economy.
okay, so the bottom 50% that's
They
using all
just don't
the
make up that much of the, when you look at the overall net, like the top of the market just overruns the bottom based on income. So these numbers on average look really good. Your point was well taken, Stephanie. The bottom half do not have high household net worth, but the top 30 is so high. These numbers keep grinding higher, and that top 30% of spenders is really what powers the economy today.
Okay, got it.
Doesn't make it right, but that's
Yeah.
just what we see. Let me go ahead and jump ahead here. We've talked a lot about inflation, growth, employment. So I'm just skipping over those individual slides. Always happy to come back if we have a deeper dive. But let's talk about the labor impact on AI. We're in the tech world. Clearly, tech's been impacted. I think what's ironic is everyone thought, you hear SaaS is dead or the SaaS apocalypse. The reality is there's been more software engineer hirings than firings this year. Because what companies are finding is they need software engineers to apply the AI. You can't just buy AI. And so we'll see kind of how things play out. But our research would say roughly 7% of jobs will be fully replaced by AI. AI will automate of individual jobs, roughly 25% of work tasks will ultimately be automated by AI. But companies aren't going to fire people because 25% of our work goes away. They're just going to give us more work to do, which is going to make us more productive and these companies more productive. We believe the market is going to require much more skilled and technical labor. You think about these build outs of these data centers. You need skilled construction workers, that you need skilled electricians, all of these call it trade jobs that maybe haven't been as attractive the last 20 years as people go into higher education. They are going to come back in a big way. We are massively under invested in those types of jobs. We think we need about 500,000 net new jobs in those types of lines of work, technical labor like construction, engineers, line workers. So as some jobs are going to go away, new jobs will get created. And so, look, there will be a washout. And in these next few years, I feel for individuals coming right out of college, it's going to be a tough job market.
Mhm.
But when the computer was created, a ton of jobs disappeared, and then entire industries of jobs were created. We would expect something more along those lines than Armageddon to the job market. And yeah, this chart's kind of interesting in the upper right. So development of the electrical motor happened right here, 1890. The productivity boom happened in 1920. So the technology was created, but it took about 30 years to get distribution set up, individuals trained, where it really created a huge movement in labor productivity. You look at the personal computer, came out in 1981. It took until about 1996 where the tech sector took off in terms of jobs. So AI has been created today. There's a ton of interesting things happen, but it's going to take some time for this to play out.
I love these longer historical charts.
Yeah.
Thanks.
It's somewhat soothing.
We've been here before. It's just
Yeah.
been slightly different. Hopefully, the world's going to continue on.
Yeah.
It does feel like you could take like so many charts and just like change the title from one statistic to another. You're like, oh, it does just keep repeating. Yeah, whatever that. Yeah.
Let's do fashion next.
All right, let's see here. So let me jump into a little bit of kind of market thoughts for you. And again, this was published at the start of the. Whoops, I went too far. What page do I want? 17. Okay. Here we go. So this was published at the start of the month. The markets moved quite a bit since April 1st. On April 1st, the S&P was at 63.69. Today, it's right around 7,000. So at the start of the month, we were saying we saw about 19% upside in the S&P the rest of the year. We've seen about 10% gains since this was published. So call it we see about 9% upside the remainder of the year. Importantly, that is all driven on earnings. The multiple on the market, which is around a 20 forward multiple, we don't think it's moving much higher. We think for the market to move higher, companies are going to have to show profits. Also, though, I think for a company to win on earnings day, earnings in a vacuum doesn't matter. What matters with earnings is forward guidance. Every investor, every is looking for, all right, next 12 months, are things like high oil prices affecting you? Is AI affecting you positive or negatively? They want to hear that. How are they applying AI to scale their business? If there's a positive outlook there, you could almost have bad earnings now. And if you have a great forward outlook, your stock's probably going to run up. Conversely, you could have really good earnings today as a software company, but if the world feels you're about to get upended by AI, you're in trouble as a company. And so, we're in a bottom-up world as it relates to stocks. We have the lowest correlation to stocks we've seen in quite a while, meaning every single company, it is based on how are they doing, not the global macro picture. But you bubble it up overall, we think earnings are going to be strong on S&P. In Europe, clearly much closer to the world war, not energy independent. We're still constructive on Europe, but we see more of a mid-single digit return between now and the end of the year based on current pricing. But you can see as we look at Asia, which is really Asia ex Japan is really called emerging markets. We've been bullish on emerging markets since the start of the year. Now, what's interesting about emerging markets is you have some countries that are firmly energy dependent. Take like a Korea, Japan, and some of the Asian nations. You have others that are fully independent. Take like a Brazil. What we like about EM is you're well diversified across a lot of different countries. But this is a world that really, over the last 20 years, has underperformed the US almost every single year except for two. And so if you say, hey, where is there value in diversification? We look at the emerging markets as a place where you don't probably want to make a big bet because it is very volatile, but it's a place that we look at that could rival US returns for the remainder of the year. And so that's where I said earlier, hey, we like the US market. We believe things like innovation here are unique relative to the rest of the world. But there's plenty of opportunity globally where we think it makes sense to spread out your bets as it relates to what you own in the portfolio. As it relates to interest rates, when you see this, we're looking at 10-year interest rates. So these are medium term, call it more like high quality aggregate bond type duration. And you see that currently it was at 4.4. Today it's at about 4.2. That's because the market's now pricing in that, hey, the straight may be opening up. And so you saw interest rates moving higher because as oil prices spiked, inflation moved higher. And if inflation moves higher, that means it's less likely that the Fed can cut interest rates. And at the long end of the curve, where I would say, like 10-year paper, why do we have the 10-year only at 4.1% at the end of the year? Why don't we see it moving materially lower than that? Well, the answer is we have a huge deficit problem in this country. And it doesn't feel like Washington is ready to face the deficit problem, regardless of what party's in office. And until we face our deficit, when the US Treasury steps to the markets and says, will you buy our Treasury bonds? As our deficit grows hundreds of billions of dollars, every time they step to the market says, yeah, we'll buy it. But we're going to need a higher interest rate on that because we don't really like what you're doing with your balance sheet. And so in the firm view, the only way we're going to see 10-year treasuries move materially below 4% is if we go into a recession. And so unfortunately, it means we don't think mortgage rates are coming down much. We think the 10-year rates are largely anchored. But at the front end of the curve, maybe the Fed can cut 1 or 2 times this year. You've seen the dollar appreciate quite a bit because of the war. Structurally, when you zoom out though on the dollar, we think it's about 15% overvalued from fair value. And so here you can see we would expect the pound to appreciate versus the dollar by about 4%, the euro about sideways, and the yen to outperform by about 3. And so when you think about that, what does that mean? What I would say it can impact is your foreign equity returns. When you have a falling dollar, that is a tailwind to your foreign equity exposure. Last year, you saw your foreign equities up the most you've seen it in a decade. Foreign equities outperformed the United States for the first time in a long time. A big driver on that was the dollar fell 10%. And that was a meaningful part of the international return. So another driver on why we want to be globally diversified and not all tied to the S&P. And then as it comes to commodities, I mean, look, trying to time own an oil right now is like catching a falling knife. If the strait reopens, oil's going to tank. If the strait closes back up, it's going back to 100. I would not recommend trying to tactically play that. What I would say around the commodities complex where we are constructive over a medium length of time is gold. Gold is a pretty interesting hedge for a couple of reasons. One, if you're worried about the US deficit, it is a different store of value than currencies. And since the United States has begun to step away from the world in certain areas over the last few years, what you've seen is central banks have considerably increased their gold positions. And so when you look at flows of data, US dollar flows have absolutely trimmed. But what's interesting is they haven't gone to other currencies. And this is what I meant by the US dollar is still by far the world's reserve currency. But what central banks are doing is they are substantially growing their gold holdings as well. And gold can help out in inflationary periods. Gold can help out if we have runaway spending. So there's a couple of interesting aspects to gold to us that merit consideration. And again, from these levels, gold's closer to 5,000 a day, but that's about 15% upside that we see in the gold and kind of broader precious metals complex. Let me stop there on some of the market outlook to see if anyone else has any other questions. I'm happy to take this any direction.
Yeah. So, Brian, Andrew posted in the chat here that the straits supposedly open, but the Wall Street Journal right now is saying Trump says blockade to remain after Iran declares strait open.
Yeah, look, I mean, we're all playing with the news as it rolls out, and that's where I said, hey, by the end of the day, it might be closed. I have no view on like what the White House and Iran are doing, nor does anyone in Goldman really have any real insight. I would say we would more say the US, Iran, China, everybody knows the economic destruction that will come if the strait is closed for a significantly longer time than the next 30 days. That's when we think you start to feel it more in the market. So we will see. We will see if cooler heads prevail or this becomes more of a left tail event, i.e. some downside in the market. But to me, like, how do you handle that? Because none of us really know how this plays out. And trying to market time we know is not the right answer. I want to just find got a pretty good chart on vol. I think it's page 27. Here we go, 26. So what this is looking at is, different ways to think about, do you want to try to time the market? And what we show you here on the left is the 50 best days in the market the last 30 years in light blue. Take a look at when the 50 worst days in the market tend to happen. They are right on top of each other. If you go back to the pandemic, March of 2020, we had 5 of the best 10 days in the last 50 years in that month. We also had 5 of the worst 10 days in the last 50 years in that month. And so trying to market time in March of 2020, you could be a hero or you could have absolutely gotten burned. The best case scenario was that you largely stayed the course and you captured all of the recovery when the market eventually bounced back. Another way to think about it, you look at this chart on the right. This is assuming that you put in $12,000 in cash in the stock market every single year. So you hand 12,000 bucks to Brio, and let's say you time the S&P absolutely perfect. You bottom tick the market every year with your 12,000. Congratulations, you have $1.9 million 26 years later. if you pick the absolute worst day to buy into the market, you have $1.5 million. The answer is don't try to market time. And if you were to just stay in cash and say, hey, I'm going to be conservative and get my 3% a year, you have 420 grand. So our view is understand your risk profile, understand your long-term goals, set a plan, but then try not to deviate when this volatility picks up. Because when it does pick up, we're going to see big down days, we're going to see big up days, but trying to market time this type of market is really, really difficult.
I am literally seeing Brandon filled with such joy to have this chart because we talk about this all the time, the clusters of volatility. So we will be repurposing this with proper references and
Please steal it and use it as you see fit.
It's so good. I feel like people like try and overthink it so much. And it's like, it's not rocket science. Just get your money in there, leave it.
Yeah.
Stephanie did have a question, and I don't know if this is outside of your wheelhouse, Brian, but crypto kind of was a big deal. Is it still a big deal? Does it tie into this? What are general thoughts?
Yeah, I don't think it ties into the market volatility we're experiencing at all, except as a derivative of the market vol. Crypto's been really volatile. Look, it's becoming a more established asset class in the sense that you're now seeing big banks begin to have exposure, begin to think about product development. Clearly, there's ETFs now out in the market where 4 or 5 years ago you couldn't buy it in a traditional liquid structure. So yeah, look, it's crypto is building more into the ecosystem of financial plumbing, of financial markets. And so it's probably here to stay. Do
Ryan, I
you
was
need
just
crypto? I mean, I think that falls more with your risk profile. And do you want that type of positioning? I think you just need to know that crypto and Bitcoin is just substantially more volatile than the stock market. So if
yeah,
you want some of that exposure, it's
I just was
reasonable, but you need
I
to size it reasonably as well.
yeah,
It
I just
shouldn't
was
be 10% of your model unless you're a very, very aggressive investor that's very comfortable with volatility. I mean, you've seen Bitcoin as an example go from $120,000 a Bitcoin down to like 60 in 6 months.
Mhm.
I mean, that's a pretty big swing. And, look, flip side is, could it go from 60 to 120? Sure.
Yeah.
But I think what's
my
more
only
challenging
question.
is understanding the fundamentals and why it moves. That's not always as clear for us as a firm.
Gotcha.
My,
Go
my
go ahead,
question
Stephanie.
was my question was just in regards to, central banks increasing their gold. You hear a lot of people are looking at, gold and crypto. That's the only spot where I was thinking
Yeah.
of it.
Yeah,
Yeah.
crypto doesn't offer the defensive characteristics of
Yeah.
gold. It tends to be when the markets are doing well, it's a momentum play and can do better than the markets. But when you start to see a pullback, when you start to see concern, it doesn't hold its value as well as maybe
Yeah.
things
Like
like gold have, at least
gold
in the
does.
run that crypto has been around. So
Yeah.
it
Got
is
it.
an interesting diversifier like a commodity, but it's going to behave very differently than gold will, if that maybe makes
Yeah.
sense.
Yeah. No, I've got it. I just didn't know central banks were doing anything with it or not.
Sure.
I just can't get over the fact that you could just like lose your key and it's all gone.
Well, that's where those ETFs help now, where you don't quite have that type of risk.
Thanks.
Yeah, for sure.
All right. Any questions for our wonderful guest, Brian here from Goldman or Brandon, about all that's going on right now? What all, we're doing Brandon, why don't you talk about what we're doing behind the scenes to sort of manage this volatility?
Hmm. I mean, I do think one of the like because normally we have John, our like portfolio manager, doing these calls. I do think it's nice for people to like hear, even if they don't hear directly from Brian, like on a like regular basis, whatever, like to get a little idea of like what's happening behind the scenes, which is like, John is talking with Brian and is taking an input from Goldman and those types of research places to figure out like what to do at Brio and therefore like with your money. What I will say though, like just to be clear, is we are like I always think of us as a very boring money management firm. Like we're incredibly boring, I think. I always feel like it's like, oh, you just like open the textbook and that's what you do. And like all of these headlines are like, Yeah, just different headlines, but you kind of need to do the same thing over and over again. I don't, I, maybe I'm getting old and jaded, but it feel like I always feel like, there's all this like news and sexy stuff. I'm like, can you just ignore that and focus on like your cash flow or your budget? Like that's really what's going to matter. Like to
Mhm.
most of our clients, like that's what's going to matter.
Well, to me, Brandon, like where your comfort level or maybe boringness is born from is the fact that you're prepared. You've already well diversified portfolio. You
Yeah.
already understand the cash flow needs. You already understand the long-term planning needs. So once everything's in place, like that shouldn't be massively changed because we get some headline in the market.
Yeah, agreed.
So people feel a little bit better armed with all this information, all those wonderful, delicious charts, Brian, which we can share with folks if they want. Is that correct?
Yeah, that's an approved deck.
Okay, excellent. All right, any other questions, folks? You're just ready to go about your business?
Well, I would just say thank you very much for having me. It's been a pleasure. And if any other questions do come up, feel free to pass them through your team at Brio, and I'm happy to address it. But I appreciate the opportunity to join, and I hope everybody has a nice weekend.
Always
Thanks.
great to have you, Brian. Thank
Yeah.
you so much. And
Yeah.
Thanks so
thanks
much.
all.
Thank you.
We'll
Thank
see
you,
you next
Brandon.
time.
Uh,
Bye, everybody.
Thanks,
Bye.
Shannon.
Bye-bye.
Bye.